Well, the Chinese central bank has gone ahead and announced a whole host of measures to boost their economy. Well, the central bank said it will cut its key interest rates and also lower the cash reserve ratio. Additionally, it also announced that it will cut outstanding mortgage rates and lower the mortgage rates for existing housing loans. Well, on the Wall Street, Dow Jones also closed a record high in previous sessions, with all three major indices ending absolutely flat. But tell you what, our guest Arnab Das is joining us, global market strategist of Invesco, is joining us to weigh in on the global market. Hi, Arnab. Thank you so much for joining us today.
To be here.
Arnab,
thank you for having me.
It's a big news, right? China's central banks have finally announced a sweep of support for the Chinese economy. China will help banks boost lending to consumers, cut its key, short-term interest rates. Now, September is a month where we were really expecting the FPIs to come back to the Indian markets, and the signs were very positive. We also saw India surpass China to become largest market in the MSCI Emerging Market Index. Now, with China trying to revive its economy and demand, how is that likely to influence the FPI flows towards India?
Well, I think, first of all, the Chinese measures will have some effect, right? As you say, they're more significant, more concerted. There's even forward guidance in a way, right, that suggests there's more stimulus, more rate cuts to come. I'm not sure, though, that it is the end of the story and that China's economy is going to take off. I think it is going to have a quite strong positive effect, but there probably needs to be some follow-through by fiscal stimulus and credit stimulus, which is what's usually worked very well in China. And there's still some chance that the effect of the monetary policy easing is blunted by, kind of the balance sheet issues that you have in the property development sector, that you have in the household sector. Of course, the stock market has come back significantly, but it's not erased all the losses that have taken place. Now, as to the effect on flows into China versus India, I think there probably will be some reallocation, right? China is a much cheaper market on a valuation basis than India is. India, perennially expensive, perhaps more so now than most of the time, right? So this will, I think, have some effect, but I don't think it's going to result in a reversal of all the outflows that have taken place from China and all the inflows that have taken place into India. I think it's also important to keep an eye on the domestic side of the story, right? A big part of the story of the run-up in the Indian market is that income has been growing and savings have been growing and savings have been financialized in India. And that continues to be the case, I think, right? So there'll probably be significant domestic inflows into the Indian market that will continue to buoy the market and attract foreign inflows. Whereas, whether there's going to be a dramatic wave of domestic investment in the Chinese equity market remains to be seen, right? You could say it's important, to have a country where residents love their equity market and are not concerned about it. I think this will, like I say, I think the bottom line is this will help, but it's probably not the end of the story in China.
Right, Arnab, you very rightly pointed out about how, Indian markets seem to be a little expensive as compared to the Chinese market. In terms of valuation, China market is relatively cheaper. Also with the, financialization of savings in India, do you think that, the FPIs hold no water any longer for the Indian markets, because there has been, a lot of buying from the DIIs and FPIs, regardless of whether FPIs flows are coming into India or not?
Yeah, look, I think like I say, I think there'll continue to be flows of various kinds into India. Some of it will be diverted to China, but not all. And I don't think it's the case yet that India is ready to allow domestic residents en masse to invest in other equity markets, right? So the financialization of savings and the increase in savings, I think in India, that's going to continue to go into financial assets, including equities, continue to go into real estate, continue to go into gold. And I think, in China, the balance of those flows have been shifting from equities and real estate towards gold and towards savings deposits. And I don't think that, I'm not sure, let's put it this way. It remains to be seen whether the Chinese people are ready to reverse course again. I think eventually they will come back into their own equity markets and their own real estate markets, but I think it's going to take some time, and it's going to take some follow through on the stimulus policies by the PBOC in the economy. And I think it's probably going to take, like I say, some more follow through on the fiscal side and the credit side in China. And if that happens, then things will probably turn up even more significantly than they already have in China. Now, what that does to India, like I say, I think there's a domestic dynamic in both countries that is significant and that is independent one from the other. And the foreign institutional investor, the foreign investor in general, and the domestic investor indeed, is going to look at all of those factors to some degree in isolation, right? The domestic institutional investor in India, I think, is going to continue to be adding to India exposure because they're going to continue to get inflows themselves, right?
Right, and let's look at how the U.S. markets are faring. Now, U.S. markets, S&P, Dow Jones, they're all trading at record high levels. Now, despite the trepidation around the slowing economy, and do you think it is time to be cautious right now and take some money off the table? Is a correction on the cards?
Well, I think you never want to say never. I mean, it could well be a correction for a variety of reasons. I mean, I think the danger here in a way is that the market is across markets in the case of the US, across the fixed income market, across the equity market, across the money market end of the fixed income, and perhaps even the bond yield curve is more or less pricing in a full-blown soft landing. So there's probably some more danger from that point of view than there usually is. But having said that, I think, I personally, I continue to be in the kind of bumpy landing camp, right? That the looseness of financial conditions and the elevation of valuations in the US, is a bit of a challenge. But I think we also need to recognize that the Fed is easing. It's eased by more than many people expected, although it had been kind of managing the market in that direction. And it is leaving its options open for a 25 or 50 basis point cut if you take the kind of verbiage from the different FOMC members together. So if the economy does slow further, I think we're going to see more easing, deeper easing, and to some extent preemptive easing, because inflation is pointing in the right direction. And of course, a lot of this so-called cycle has been, in a way, not that much to do with the Fed, right? It's been about lockdown and reopening. It's been about supply side shocks in international shipping and supply chain logistics, and about the war, Russia-Ukraine in particular, maybe less the Middle East war. And a lot of those things are starting to normalize now. And so the supply side pressures have moderated, although they haven't gone away. The demand side pressures on inflation have moderated as well, although they haven't gone away completely. And so I do think the Fed is unusually, if not uniquely, positioned compared to history to engineer something closer to a soft landing. But there are dangers ahead, right? And I would say the dangers are there, clearly from the labor market side because the economy is slowing. The dangers are also there in political economy, right? There's obviously a very important election coming up with, I think, two very starkly different plans and offerings for US fiscal policy, for immigration policy, for international economic policy generally through trade. And all of these things could have significantly different effects on the market's perception of potential growth and of inflation and of how tight the labor market is, right? If immigration is going to be slowed meaningfully or even reversed through the deportations that have been threatened, then that speaks to a significantly tighter labor market, which may buoy labor income, but probably slow the Fed down in 2025.
Right, right. Also, Arnab, there is escalating tension in the Middle East, especially now with the attacks on Lebanon. And if the tension is likely to continue or to escalate in the future, how is that likely to impact the global markets and the demand going ahead?
Well, I think it's something, it's a tail risk. The war is real, it's tragic, and so forth. And of course, as you say, it is escalating. But I think the tail risk element here is whether the war not just escalates between Israel and Hamas, Israel and now Hezbollah, and potentially, Iran itself, but really escalates to a more open confrontation, let's say, between Israel and Iran. And I think that is still, looks like a bit of a tail risk. It doesn't seem that anybody really wants to enter into a full-blown confrontation in the Middle East as a whole. And it seems to me that, the bigger picture here is that, the war is one very important challenge, but the bigger picture here is that everybody who is a major oil producer in the world wants to continue to pump oil. Oil demand had been, sort of softening. If the US is slowing down, China had been soft. Maybe it's going to accelerate a bit. Europe has been softening. India doing well, but maybe also slowing down a little bit at the margin, right? So a lot of the major oil consumers already showing signs of being soft or slowing down. Maybe that will now improve with the stimulus in the US, the stimulus in China, and so forth. But I think the bigger picture here is that Saudi Arabia, Iran itself, Russia, other major oil producers, and the US itself, of course, is a major energy producer, oil, natural gas, and now an exporter in a big way of natural gas as well, will continue to pump oil. And I think that will probably help keep a lid on the oil market and the energy market generally, unless there is a much wider conflagration in the Middle East, which, as I say, I don't think anybody really wants that.
Right. Thank you so much, Arnab. We're completely out of time on that one, but thank you for taking the time out and joining us today.
If you like this video, then like, share and subscribe to ET Now.